Zoom stock is down 70%. They report earnings this afternoon. I'm gonna give you an earnings preview and tell you if I think the stock is a buy, sell, or hold right now. All right, this is a chart from Zoom from our friends over at Wiijii, W-I-I-J-I-I. You can find it in the first link in the description below. This is a free tool, and it's a pretty cool data visualization tool to learn things about different stocks. So we can see that Zoom in August of 2021 was up near 340, and now it has traded down to 99 per share. Crazy drop. But during that time, quarterly revenue has grown from 640 million all the way to $1 billion per quarter, which is pretty incredible growth over 2 years. But here's the problem. Here's why the stock has dropped so much. Revenue was growing extremely fast. The stock was trading at a very high multiple. And now, just partly due to a nature of the law of large numbers, once you get a large amount of revenue, it's hard to keep growing that number as fast, right? They were growing revenue at 370% year over year. And now, as of the last quarter, it has dropped down to 12% year over year. That's a lot of the reason that the stock has come down the way it has, and people just got too excited about it. If we take a look at gross margin, which is a measure of the company's profitability, it's actually been pretty strong. So they had 71% gross profit margin back in July of 2020, and now they've actually stepped it up to right around 76% gross margin as of last quarter. We'll see what comes in this quarter. And EBITDA margin, so surprisingly for a company that's growing as fast as Zoom has, it's actually a profitable company. So they had almost a 30% EBITDA margin in July of 2020, and it has dipped a bit as of April 2022 to 18.8%. Net income margin, same deal. It was up near 30% as of July 2020. They had a really strong quarter, 45% that they reported in January. And as of their last quarter, though, that net income margin took a big hit and was at 11%. Okay, free cash flow, and this is pretty incredible how much this business is generating. So it was right around 370 million in July, dipped down in January of 2022 to only 185 million. And then in April jumped up to $498 million in the quarter. Pretty incredible. And then this is another thing we like to look at, just how secure is the company, right? And so for the challenges with Zoom have been on a premium multiple. There was too much growth expectation built into the stock. The business, it's hard to argue with how reliable and strong the business is when you take a look at free cash flow, profitability, and their balance sheet. So they started with 1.4 billion in July of 2020, and now it's up at 5.73 billion as of last quarter. This is one of the first times I've ever shown Wiijii on this video, so let me know in the comments what you think of this tool, and then remember, check them out. First link in the description. It's completely free for you. Let's get an idea of what analysts are looking for this earnings, which they report this afternoon. Make sure you like this video and subscribe to the channel, turn your notifications on, because I'll do a review of their earnings once they come out, and we'll see how the stock reacts, right? Anyways, they report today after hours, August 22nd. Expected normalized EPS is 93 cents. GAAP estimated EPS is 37 cents. And then they're expecting 1.12 billion in revenue, all right? Okay, if we take a look at their earnings, and this is what's just been incredible. The first quarter of 2020, we'll go to the first quarter of 2020, 3 cents EPS, $121.9 million. Last quarter, Q1 2023, so this is 3 years, $1.03 in EPS. So they increased that by $1 and went from 3 cents to $1.03. And then 1.07 billion in revenue, up from 121 cents. It's almost 10x the revenue in 3 years, which is kind of insane. But the challenge is are they going to continue growing this, or have they tapped out on their growth? That's the question everybody's asking. So again, these are the numbers that the Wall Street's going to react to. What do they post for EPS for this quarter? What's the GAAP EPS? What's the revenue? What is next quarter's guidance? And then what is the guidance for the rest of the year? And what we really have to do when we think about investing in any company is compare to what our other options are out there to invest in, right? And so these aren't perfect comparisons, but I picked companies that you can essentially get some of the same services at least that Zoom offers, and also some of their competitors in the market, to just see how Zoom is valued compared to other things that you can invest in, and then potentially their competition as well. If we look at the total size of the company, Zoom, basically all video communications, right? 29.69 billion. If you look at Google and Microsoft, which we know what they do, search, they do have their meetings with Teams and Google Meet. They have cloud, they have all kinds of different stuff that you're invested in. Much, much, much larger market caps. We're talking about 1.5 trillion and then over $2 trillion, okay? If you get to more similar comparisons in size to Zoom, you've got Twilio at 14 billion, Ring at 4.3 billion, and Five9 at $7.6 billion. And we can see just how crazy this has been. So down from 52-week highs, Zoom minus 72%, Google only down 22%, Microsoft down 18%, Twilio down almost 80%, Ring down 85%, and Five9 down 43%. Crazy, crazy drops there. So let's take a look 3 years out. We like to be long-term investors here. What if they hit their non-GAAP earnings per share estimates? What is their non-GAAP PE ratio? So Zoom, and this factors in some growth, right, is at 22, when Google's at 17 and Microsoft's at 20. So that's a question that people are asking themselves. Like, if you're going to invest in Zoom right now, do you want to invest in Zoom, which has some questions on what they're going to do potentially, and it's a very risky stock, when you could own Google on a forward 3-year PE that's 17, that's 25% lower than Zoom's, and then Microsoft is about 10% lower. So, a lot of people are probably just a lot more comfortable owning these two than something like Zoom, and that's understandable if that's how they feel. Twilio is 108. It's not a real comparison there just because of their unprofitability. Ring is at 14.3, and then Five9 is at 43. Now, here's where a stock could earn or not deserve its premium valuation, right? So if we look at what their 3-year CAGR, the growth rate of revenue has been over 3 years, we start to get an idea of how fast this company has grown and then how fast they might be expected to grow in comparison to how fast they've grown in the future, right? That does matter. 120% revenue CAGR over the last 3 years is pretty incredible for Zoom. Google, 23%, Microsoft, 16%, Twilio, 56%. A lot of this is through acquisition. Ring Central is 32%, and Five9 is 34%. So we can see over the last 3 years, Zoom has really outgrown any of these in terms of revenue growth, right? That's kind of to be expected against Google and Microsoft. So with that in mind, what does revenue growth look like for the next year, growing off of this fast pace? And the question with Zoom is, have they penetrated more of their market to where it's going to be challenging for them to continue to grow fast, like because of COVID and all of that stuff? That have they brought a lot of the growth forward that was already expected, or is this growth new growth that they're going to continue to grow on top of? That's the challenge with Zoom right now. So looking forward a year, the markets analysts are expecting 24% revenue growth for Zoom, 21% for Google, 14% for Microsoft, 41% for Twilio, 27% for Ring, and 30% for Five9. Here's where Zoom kind of starts to shine a little bit in one area that it doesn't, right? So gross profit margin, compared to Google and Microsoft, Zoom is beating them, right? So 75% gross profit margin, Google's at 56%, and Microsoft is at 68%. So I could tell you based off of really just this comparison, if this was the only thing that I could look at with these companies, I would essentially just remove Twilio, RingCentral, and Five9 from thinking about buying them. This is just me. And the three that I would consider are Zoom, Google, and Microsoft. So let's jump over. This is Everything Money. They've got this kind of 8-pillar thing where they look at 8 pillars of what they think makes a sort of like a solid company. Doesn't mean it's a buy if they do well here. It's just sort of this filter, which I like using this just to get an idea. So their 5-year PE ratio, they want to see that under 22 right now. It's at 71. 5-year return on invested capital over 9%. They're at 10.8. That's great. Revenue growth over 5 years. They have revenue growth. Net income growth. They have net income growth. Shares outstanding are up 25%. So that means they're issuing more shares, which is something to watch. You want that to not happen at as fast of a rate going forward, because it's hard for a company to be a good investment if they continue to issue more and more shares. Long-term liabilities to 5-year free cash flow of under 5 is 0.3. We talked about that balance sheet. Cash flow growth over the 5 years. Yep. And then 5-year price free cash flow is kind of the same situation as PE, so not too concerned with that. Okay, and the other two we were looking at, just to give you an idea, Microsoft and Google, we'll see how they do on 8 pillars. I'm sure they're going to be almost all 8 green. So pretty much same score as Zoom here. They do have an elevated price earnings ratio and an elevated price free cash flow ratio. That's Microsoft, Google, and same deal. This is showing us that the PE ratio and price free cash flow of these companies is a little bit higher than what this screener likes, but they're strong companies in terms of balance sheet, shares outstanding, and stuff like that. What I've done here is I've just looked at, if we want to think about long-term investing, then I'm going to use kind of a 10-year analysis and look 10 years out what the business could look like. I've pulled these numbers from basically assumptions that analysts are expecting for earnings growth out through 2027 or so, which are all just guesses and assumptions, but I've kind of modeled it off that, so I'm not just making these numbers up, right? Anytime you do this though, you're making assumptions, so it's important to know that. So if we look at, on the low side, we've got low, medium, and high. On the low side, we're looking at 10% revenue growth, medium is 12%, and then high is 15%. And so this is on average, essentially, over the next 10 years. Profit margin, 24%, 28%, and 28%. Free cash flow margin, 25%, 29, and 29. A PE ratio, and this is 10 years from now, what would the PE ratio be? So as a company gets more mature, you expect the PE ratio to come down a little bit because it's harder to continue growing earnings as fast off of large numbers, kind of like that. But when I think about this, I think about companies like Google, like Microsoft, that are trillion-dollar plus companies at this point, still are trading at PE ratios of 16, 18, 20, in that range. So it is certainly possible for a company that is only at that age, at that point, Zoom would be, 15 years old or so, 20 years old, to still be growing earnings at a decent rate and to have a PE ratio of 18, 20, or 22. So I think it's in the realm of possibility. I just did the same thing for free cash flow and then desired annual return, 13%, 13%, and 13%. Hit analyze. And this tool tells us if you think the low side is the most likely scenario, Zoom is not a buy unless it's under $74 a share. It's at 97 right now, so still got a ways to go. If you think the midpoint is a realistic scenario, then Zoom is actually a buy right now, but it's close, right? It's at 97 right now. Midpoint's telling you 107. If you think the high side is the likely scenario, which I think that you shouldn't think that your high scenario is the most likely. It's probably the most unlikely to happen. But that means that you'd be willing to buy it under 143 a share right now, and that's at 97. So pretty significant upside if you believe in that high side scenario. What does this mean? Zoom reports earnings this afternoon. I personally think they're probably going to beat expectations, and guidance might actually be stronger than analysts are expecting. That's kind of what I think is going to happen. But what I think and what I do investing is different, right? I don't just invest based off an intuition or a hunch that I have. I invest based off numbers and potential outcomes, probabilities, and then assumptions over the long term, and I compare it to other things that I could be invested in. And the bottom line is that I'm not going to buy Zoom today. I'm not going to buy it after earnings, no matter how good or bad they are, because there's other companies that I want to own right now. I'm actually going to be making my next purchase tomorrow in the $10K to $1 million portfolio. And I'm going to share everything, my reasons for buying, in an email with my newsletter subscribers tomorrow morning, austin.substack.com. It's in the description below, so make sure to check it out. Thanks for watching. Like the video, subscribe, and have a great day.